Before buying any product or service, we always ask for the price. It's a practice that is hardwired into us, and for good measure, because one does need to know the price. The price of gold, the price per square feet of land, the price of a share, and so on. But one industry that never uses the word price in its dealings are the mutual fund companies. After all, there is no fund price, and instead what is published is the fund's NAV. And so in this video, we shall examine the many facets of this cardinal industry term as we understand what a mutual fund NAV really means, how is it calculated, when is it calculated, and most importantly, the confusions, exaggerations, and fallacies that many investors face when working with a fund's NAV. Let's begin. The net asset value or NAV represents a fund's per unit market value on a particular date. In other words, the NAV is the number at which investors can buy mutual funds from an AMC and likewise sell units to an AMC on a particular date. This, of course, brings us to the question, how is an NAV calculated? Very simply, the NAV of a fund is the total asset value of the fund minus the expense ratio, which is then divided by the number of outstanding units in the fund. While the expense ratio and outstanding units are rather straightforward, it's important to have a deeper understanding of the term total asset value. Now, the total asset value of a fund includes a number of items. It includes the stocks, bonds, cash, and other securities, all of which are taken at the market value. It also includes any interest that is accrued on debt instruments and any dividends that are received on equity assets. And finally, it also accounts for any borrowings, provisions, or liabilities undertaken by the fund. Now, since the market value of investments change by the minute, consequently, and in an ideal world, the NAV too should be changing at a rapid pace. However, since it's not possible or practical for the fund house to compute it in real time, a fund's NAV is calculated and published at the end of every market day, which then leads us to the question, at what NAV is one allotted units or is allowed to exit a fund? Now, just like how the stock market operates within a time window, mutual funds too have a cutoff time for entering or exiting a fund. The intent of a cutoff time is not to restrict the purchase or sale transaction, and the purpose of it being there is solely to decide on the NAV at which the mutual fund unit will be allotted or redeemed. More importantly, the allotment of units depends on the type of fund category, the time of submission of the application, and when the investment money is received by the fund house. For instance, in the case of liquid and overnight funds, the cutoff time for purchasing units is 1:30 p.m., which is a bit different from the 3 p.m. deadline that all other funds follow. Similarly, from the 1st of February 2021, the SEBI has made it mandatory for all fund houses to ensure that the NAV that is applied on the purchase of mutual fund units takes into account not only the time of receiving the instructions, but also the time of realization of funds. While something like this might be relevant for someone who looks to time the market, but if you are a long-term investor, then this should not be much of a concern. But what is of real concern is half-baked or complete lack of knowledge on such simple concepts like an NAV, which might then lead to mistakes by investors or can make you a victim of unscrupulous mutual fund agents. And so the rest of this video will be about understanding what these conflicts are when it comes to the NAV and what is the real truth behind them. But having said this, one area where there should be no conflict is the utility of ETMONEY's YouTube channel as your go-to resource for investing and personal finance knowledge. So if you haven't subscribed to the channel or know someone who's still on the fringes, then do help them take the next steps and make them a part of our growing family of over 2 lakh subscribers. This might come as a surprise to many, but some investors assume that the NAV is the price of the fund. What I mean is that someone would look at two funds, let's say a liquid fund, which is at an NAV of 1000 rupees, and a large cap equity fund, which is at 50 rupees. And they would conclude that the liquid fund is 20 times more expensive than the large cap equity fund. Now, I'm sure this is perhaps the most ludicrous thing you might have heard today, but we have come across many investors who are still hanging to the NAV is the price notion and are making some big investing mistakes in the process. So the truth of the matter is the NAV is not the price of a fund. In fact, a more powerful variant of this misbelief is where some investors equate an NAV with the market price of shares, often assuming that both these things work on the same principle. But that's not true. After all, the price of a share is nothing but the collective view of all market participants who buy and sell that stock at different prices. This makes the determination of a share price a classic demand and supply situation with higher interest in the stock leading to a higher price in the stock exchanges. On the other hand, none of this matters when it comes to the computing of the NAV of a fund. And that's because the forces of demand and supply don't work in this case, and one can buy or sell as many units of the fund at a given NAV without impacting the NAV in any way. Unlike a share, the NAV merely reflects the weighted average value of all stocks and other assets that are held in its portfolio, and the growth in NAV is reflective of the fund manager's skill in managing the portfolio through the ups and downs of the market. NFOs are cheaper than other schemes because the NAV is just 10 rupees. This statement always was and continues to be the oldest trick in a mutual fund distributor's playbook. Every year, tens of thousands of investors fall prey to this very myth, and it is very unlikely that you'll find a mutual fund company educating investors on this point, and one can understand why. So here's the truth. It really does not matter if a fund's NAV is at 10 rupees or if it is at 100 rupees. When we invest in a mutual fund, we invest for future returns, and what really matters here is the growth in NAV and not the absolute value. In fact, this is something we at ETMONEY have been saying for some time now, and if you haven't watched it yet, then do take a look at a popular video we have on the subject where we make a case for thinking twice before investing in an NFO. Now, another related misconception is that funds with a higher NAV have already peaked and hence offer a much lower scope for growth as compared to an NFO. As one can see, this flawed notion is promoted by some agents to gullible investors to make the NFO not only cheaper, but also something that has more upside attached to it. I am sure you will agree with me by now that this is absolutely absurd and a completely fabricated notion. The lower the NAV, higher is the number of units one would receive. Well, on paper, the statement is absolutely correct, but the real question at the end of the day is, how does it matter? After all, we don't invest in a mutual fund to collect units. We invest in a fund to secure an adequate and acceptable growth on the money invested. In fact, let's look at this with an example. Okay, so let's have two large cap actively managed funds, the Franklin Blue Chip Fund and the IDFC Large Cap Fund. Now, about a year back, the NAV of the direct plans, that is the Franklin Blue Chip and the IDFC Large Cap, was about 453 rupees and 36 rupees respectively. And mathematically, this means that for the same amount invested, the IDFC unit holder would receive about 12 times more units as compared to the Franklin unit holder. Now, over the past year, both fund managers did their best, and on the 9th of September 2021, we see that the NAV of the Franklin Blue Chip Fund has grown a bit better than the IDFC Large Cap Fund. More specifically, this means that the investor who had put his or her money in the Franklin Fund had gained a lot more in spite of having been allotted a lower number of units. The point is clear. NAVs and units are the same side of the coin, and having a lower NAV or a higher number of units in isolation is not likely to have any consequence in your ability to generate wealth on your invested capital. What really matters is how these funds grow in the future and the rate of return that they are able to deliver to their unit holders. Until now, we've been focusing on the inexpensive side of NAVs, but as it so happens, there are fallacies at the other end of the rope as well. And perhaps the biggest argument made by misinformed investors or deceitful agents is that funds which have high NAVs are also the better performing funds. Now, I know this sounds preposterous, but the best way to squash a misplaced belief is to examine it with data. And that's exactly what we did. Our research team went back 5 years and examined the NAVs of 27 large cap funds in a bid to understand if selecting a scheme with a high NAV actually gives us a better performance. And what we found is that there was nothing that indicated that a fund having a high NAV or a fund having a low NAV had any form of visible performance advantage. In fact, the table here shows that the 5-year performance of funds across different NAV slabs was well within a small plus minus 0.3% band, which is hardly significant. We even detailed out the data looking at it across multiple years, multiple categories, and even did a fund by fund ranking, but we could not find any causality between the performance and the NAV. So if you're still hanging on to the lower NAV is better or a high NAV is better, then maybe it's time for you to reconsider. So the next time some cheesy sales pitch comes along, or you have to explain an uninformed colleague, point to the following. 1. The NAV is not the price, and funds cannot and should not be compared on the basis of their NAV. 2. The concept of an NAV and a share price is very different and definitely not comparable. Thirdly, an NFO is cheap at 10 rupees is nothing more than a trick. Point 4, while a lower NAV might give more units, there is nothing to indicate that it is better for the investor. And finally, a high NAV fund does not mean a better performing fund. All said and done, the primary purpose of the net asset value or NAV is simply to help investors evaluate a scheme's historical performance in terms of returns. It is a relative measure and in isolation does not have any noteworthy utility. So if identifying the right fund is your objective, then be sure to turn a blind eye to its NAV and instead focus your efforts on figuring out the scheme's suitability, its track record, its consistency, expense ratio, Sharpe ratio, its concentration risk, fund management style, and other relevant factors, all of which are reported and factored in the ETMONEY Fund report card that's accessible on our app and website. And with this, we come to the end of this presentation. If you learned something new today, either for yourself or for someone who might be new to investing, then do consider liking this video. Once again, thank you for your time, and I look forward to catching up with you next week with another insightful video. Until then.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.